Hello. We're now going to continue our discussion on financial markets, looking at it from a risk and reward perspective. We're going to look at it from an asset class. We're going to look at it from an analytical perspective. So we're going to get into a little more depth on it, not just from the corporate perspective, but also from the investment and trading perspective. The first thing I'd like to do is just do a few definitional things here. Saving and investing are not the same thing. Saving is the act of putting money aside from your income for the future. So you're saving it. Okay? Investing is what you do with the savings. Okay? Because it's two separate things going on here. Investing is what you do with the savings. Saving is putting money aside from income. Trading and investment are not the same thing. You will oftentimes hear people say, "Oh, I'm investing in the market." Well, there's a distinction. Trading and investing are not the same. Trading is an activity performed in a short period of time, and that could be anywhere from seconds to days to weeks to months, but to profit from market fluctuations. Okay? The strategies used there are very different because you're looking for movement to make short-term swings. Investing, on the other hand, takes a longer-term view of the portfolio with assets based on your time horizon and what you're looking for. So they're two separate things, and try to distinguish between them. You might be trading to make short-term profits. Investing is more long-term, and you're going to take a different approach as we move forward. Let's take a look at risk and return opposite financial markets. We took a look at it from interest rates, and this is a very similar concept, but a little different. Return is how an investment performs over a period of time. Risk, on the other hand, is the degree which you could lose money. Okay, so return and risk. And as you would expect, there is the greater the potential return, the greater the risk. So as you can see from this chart, is that if we have something that has low risk, the return tends to be over time lower. The higher the potential return, the higher the risk. So it's a trade-off between those two. And I want to take a look at risk from an investment perspective, financial equity markets, and let's take a look at what these types of risk are, because there's multiple risks, and a lot of times you need to take into account all of them depending on whether you're trading or whether you're investing. Now, the first one we have is a market risk. This is what's going on in the financial markets today, and that's the possibility of your investment decreasing in value. Two things here. One is it could be the business risk. So that's within a certain business, their performance is changing. Their product may not be in demand anymore. Costs may have gone up. They may have had some bad acquisitions, but it's a business risk. It's based on the performance of the underlying business. Then there's the macro risk. Right now we're seeing the markets in a very volatile state, up and down. Not something specific to the company. Nothing has changed with the fundamentals of the company. It's just that there is this events going on. And if you've been watching the market over the past couple of months, we've seen there's a lot of these risks have influenced the market. So distinguish between the two of them. I don't think anything has changed with O'Reilly in the past 3 months from a business perspective. Doesn't appear that their sales are slowing down. There's no indicators of that, but yet their stock price has gone down. These are the macro events. Next is what we'll call the inflation-deflation risk, and it can go both ways. And that means that there's a risk that over a period of time you could have increasing or decreasing purchase power. Inflation, as we talked about up front, is the rising costs of goods and services. If it runs 3% for 30 years, $100 worth of food today would cost $2.50. So there's a risk that if you're not making more than inflation, you're simply walking in place. But if we assume the interest rate is going to be 2% and we're earning 1, we're actually losing money. There's an inflation risk. Deflation is declining costs and services. So that is on a positive side, but most of the time we have this inflation risk is that we may enter into an investment that if it only pays 2% and inflation runs 3%, we're actually losing money. So that's a risk. The risk comes into account on longer term investments. Inflation, deflation risk is not on a shorter term investment and not in a trading venue. Okay. Next is our liquidity risk. Okay, and that's the risk of not being able to get out of your investment quickly at a reasonable price. So what we have is listed stocks like Apple. There's enough liquidity in the market that you can do that. But if you own a piece of real estate, it may not be able to get the money, the cash out of it on a very quick basis. Then we have interest rate risk. Changes in interest rate impacts the value of fixed income securities. It can impact the future cash flow of a company. So that's a risk. And then there's an opportunity risk. By being invested in certain assets, you may lose the potential gain of other assets. So whilst you might say, I don't want to lose any money, and you might say, okay, I want to avoid this market risk, so I'll keep it in a 1% savings account. Well, the opportunity risk is that maybe if you were in equities or bonds, you'd actually make more. So you lose those potential gains. So when we look at risk, there's multiple risks. So when we talk risk, you really want to be much more specific. So we got the market risk. Remember this. This is going to be a really good question for the last quiz. Market risk, inflation or deflation risk, liquidity risk, interest rate risk, and opportunity risk. So make sure you know what those risks are. Now, let's look at risk from your perspective. And the best way to manage risk is to balance them according to your time horizon. The sooner you need the money, you got to have a purpose of when you're going to use money. The market risk is more important than inflation. The longer the time period that you're involved in, the greater the inflation risk and less the market risk. So if you're saving for retirement, your greatest risk is outliving your money. So you need to make sure that you're dealing with all of these risks when you're doing that. We then look at, risk comes into, we look at this, there's really three things when we look at it as individuals. We all have a perception of how much risk we like to take, what we prefer to take. This is what our mind is telling us. So, yeah, I want to be risky. But then it's not always an independent decision about how much risk we prefer. It's how much risk do I need to take to achieve. So if I said your greatest risk is outliving your money, you need to take risk so what you're saving for retirement in your 401k actually will grow. You need to take certain risk. Then there's the risk capacity, is how much risk can you afford to take. So we look at these three things and say, what's the risk? And it's really a matter of what you can tolerate from a psychological perspective. How do you sleep at night? What do you need to take? We all need to take risks with certain things, but how much do we need to take? And then how much can we afford to take? So I think that starts laying some of this out, that risk is more than just movement up or down. And you have different reasons for risk, and it's a balance act. I do want to talk about the difference between risk or volatility. There's two different things. Often they're confused. Volatility is more about short-term market swings and the depth of the swing. And when we look at that, we might have two different investments. Each have a 5% annual return, but A may be consistent and have 5% each year. B may have 10% and -5% the following year. So volatility is how is it's moving. Risk is over a period of time. So what we're seeing in the markets today is volatility. The next piece, you can invest in many things. So many things, so many different companies, so many different instruments. But you want to look at it from both perspectives. First, what are the risks and what's your risk tolerance? Making sure you understand what you're getting into. And what tolerance do you have looking at all three of those components? And then, when do you need the money? Next one to focus on is return from investing. And that's really threefold because you're investing for a reason. Okay? It's to generate current income, bond interest, stock dividends, rent. That's one. And then there's capital gains, increase in market value. That's what you're hoping for. Now, when we look at it, there's realized and unrealized. Realized only occur when you actually sell the security. Unrealized is the difference between what you bought it for and the current market value. And then there's interest on interest. How do you reinvest those to get the powerful effects of compounding? Generally, we refer to different types of investments by asset classes. And this simply is a way of distinguishing investment or to a group of assets that share some common characteristics. Okay, so it's a trade-off, these asset class, between risk and reward. The first one is we'll call stocks or equities. We then have bonds or fixed income. The bonds are issued again by the corporation. We've talked about that. Stocks, we've talked about that. Then there are treasury bills. These are securities issued by the U.S. government for a short period of time, generally 90 days. Then there's cash, okay? And then alternative investments. Each one of these has unique risk and return characteristic, and therefore different levels of performance or return over a period of time. Let's just hit some of the key things on common stocks. Each share represents equity or part ownership in the company. The investor participates in the firm's profits and in the losses. And stock ownership is residual, so it's left over once. So if you look at all the company's assets, once you pay off all the debt, what's left over belongs to the shareholder. It's residual. But since this is a going concern, it has the opportunity to generate future cash flows or income, therefore it has value. And then we have book value versus market value. Book value, which is on the balance sheet, and the market value we talked about in the previous lecture is the market capitalization, which is the number of shares outstanding times the market price. Yes, there will be a difference. One, there's a difference because there could be assets on the balance sheet, there could be assets of the company that are not on the balance sheet. But again, the valuation of a company is based on its ability to generate profit into the future. So you're looking about this, if you come back about what future value is, we're looking at its ability to generate cash flow in the future. So that's a little bit on invest common stocks. You also have voting rights and usually receive one vote per share. And most small investors assign their votes to a proxy, someone else to vote on their behalf. So you have the right to vote. What are you voting on? You're voting on the board of directors. You're voting on executive compensation. You're focusing on appointment of an auditor and other matters that may become from mergers, acquisitions, that come before the shareholders meeting, which is an annual event. Dividends. These are payments out of earnings, and they're determined by the firm's board of directors. They're generally paid quarterly. They can be special dividends, but it's a sharing in the profits. It's paying out of the profits. Dividends can pay even if a company shows a loss. And that's something that as you get into some more advanced fundamental analysis and financial statements analysis, you'll actually get a little more into that. Some basic cash distributions. Dividends and long-term capital gains are taxed at a maximum of 15, 5% if you're in the 10 and 15% brackets. Gains are not taxed until realized. So those are long-term gains. So if you're trading and you're not holding them long enough, they're going to be ordinary income to you. Keeping going on some of these, investing in bonds. We've talked about that previously. It's a fixed income security. Remember, interest rates and bond prices move in opposite directions. They're very versatile for an investment portfolio. You can have them in short duration, medium duration, long duration, high credit risk. Remember we talked about the different credit ratings in the previous interest rates, risk, and reward. It's preservation, holding on to your capital. So if your credit is good, your movement is going to be based on the interest rates. Over time, lower risk and return than stock. Okay? That's sort of the way it works. Now, as we said, some of this is repetitive, but bondholders lend money to the issuer. Interest is usually paid every 6 months, and coupon, annual interest rate paid by the issuer, maturity date when the loan ends and you have to repay the whole amount. Then we get into the alternative investments, and this is a very big space. Real estate, a commodity. We can invest in any commodity you could think of. There's forex trading, and which is trading currencies. All these are alternative investments. Bitcoin would go into this area here. We use the word private equity, and that can be considered either an asset class called equities, but it's the difference between a private equity is that it's not publicly offered. It's a private equity. So there's so many different things you can invest in. Each one has its own unique risk and return. This chart is one of my favorites, and I do have it out somewhere to 2017, but what it does is it says from 1900, right down here, to today, if you invested $1 in 1900, what would it be worth today? If you invested in stocks, $21,481. If you invested in bonds, that dollar would be worth $294. Treasury bills would be worth 71. Pure inflation would get you at 25. So what you can see is over a period of time, and what this is telling us is that over a period of time, stocks outperform every other asset class. But look at the smoothness of the line. The inflation is a more smoother line. So is the Treasury, but there's a little more volatility or up and down. So we see the most volatile, this up and down movement here, is in equities. So this is the volatility over a period of time, but as a long-term time horizon, it significantly outperforms. And I want you to keep this in mind. And then when we actually look at a histogram of the returns, we can see that it tends to be around that the extremes going one way or another are far, it's a little tail. It's almost a normal distribution if we look. So we want to keep that in mind. And we can approximate the unknown possibility. We don't know what the market's going to do. But statistically, it tends to follow a pattern. This is just mathematical. A lot of times it's a point of view, short-term versus long-term. So I might be looking at this as short-term might be trading, long-term is investing, but look at it from the point of view of what type of person is participating in the financial markets. Today, more than ever, America is focused on quarterly results. What did you do today? And the equity markets have been focusing lately on short-term results and news. So we hear a bad piece of news, we make an assumption, we hear something, like we had last, depending on when you're watching this, we had our Secretary of Treasury Mnuchin came out and said there's no liquidity problems. He's talked to the banks. Well, the market said, well, why was he even asking about liquidity? Does he know something we don't? And the market reacted very sharply and dropped off. It reacts to news. Okay, so again, you short-term, long-term, what's your point of view as a trader versus an investor? Okay. With equities, they can move up and down. We've seen that. They have risk. But the price overall of an equity is driven based on the expected return of the firm, its earnings. What's that going to do? But then you get into the Times that really looks at three different things that I want to focus on. It's often impacted by macro events, not what's happening with the firm. So we want to try to distinguish, is this movement between, it was something that the market as a whole changed, a macro event impacted it, or was it the actions of the firm? Did they change management? Is there a new product, or is the product that has liability now? Have they changed the process, innovation? So actions of the firm can cause an increase or decrease in value, independent of these broad market indicators. These are being constantly monitored by investors and analysts who support them. And I throw investors and traders into that. The real underlying value is the cash flow. What's going to happen? And in this course, we don't spend as much time on the valuation and determination of future cash flow. We look at equities. We tend to break them down when we're looking at them as a whole. Individual stocks, but you look at them within the context of what they are. I don't like that. When we look at equities, they're sometimes analyzed and broken down into different components, different approaches. The first one we have is U.S.-based companies versus foreign-based companies. Different countries have different growth rates, different economic cycles, different rules and regulations. Now, that doesn't mean that a U.S.-based company such as Apple doesn't have a lot of business overseas, or an overseas company such as Unilever has a huge presence in the U.S. So it's not where they do business, it's where they're headquarters. Based on the size of the market capitalization. Okay? Market capitalization, I think, as we said, is the current share price multiplied by the number of shares outstanding. Share price can be found on the Wall Street Journal and the number of shares from 10K. So the market capitalization may determine the size of the company. And that determines some of the characteristics that we like to see when we're looking in those different categories. That includes large, those that have over 5 billion in market cap, medium 1 to 5 billion, and small less than a billion. So they oftentimes, when you look at a group of equities or a portfolio, you break it down first by U.S. and foreign, then by size. Then you can break it down by what we call sector. And these are, again, sectors are part of the market broken down. We have those that move cyclically, meaning in cycles, which are basic materials, consumer cyclical, financial services, real estate. These tend to move in a cycle. Then we have defensive, which are those that are necessities, if you will. Utilities, healthcare, consumer defensive, toilet paper, Procter & Gamble. So when you think about these things, if we have an economic downturn, these companies remain relatively strong. Okay, the utilities are they're solid performance. They're not going to make you a lot of money. In fact, little money at all when you really think about it. But they pay a dividend. People always need utilities. Healthcare, we all need healthcare. Consumer defensive, we all need toilet paper, food. So they perform in a little differently. And then we have those that are very sensitive to market changes, disruptive technology, communication, in energy, industrials, and last but not least, technology. So we have these sectors and they're further breaking down. Now, why do we do that? Is what I did here is I'm showing you, this is out of ACO, which is a Goldman Sachs subsidiary. And what it does is it gives you each year different asset classes and or portfolio mix performed differently. So you can see by color that some years they produced a lot, in other years they didn't. So when you look at emerging markets, there's 3 years, 9, 12, and 17, that they were top of the market. But other years, they're down here at minus 14, minus 2, minus 18, minus 53. And so far this year, they're down almost 20% in 18. So it's all over the board. So what you end up with, if you're putting a portfolio together or looking at it, you want to try to balance your risk. So instead of putting all your eggs in one basket and making a big bet, by spreading them out, as it shows right here in these two models, a growth model and a moderate model, which has a little bit of everything in it, it tends to be more consistent in not hitting the highs and the lows. But you can see that REITs tend to have been on the top for over 18 years when you do it on a annualized return over that period of time, 2001 to 17. Emerging markets are strong, but if you're on the right side of it, yes. But if you're on this bottom side, you're not always happy. So you don't want to necessarily do that. A very powerful chart, and that's what's keeping us a balanced portfolio, that our risk is spread out so that there's a relationship between our risk and reward. Now, when we further break it down into sectors, again, we see that it moves all over the place. When we look at it, on the top, if you look 2007 to 2016 annualized, consumer staples comes on top, IT, technology, consumer discretionary, and the bottom are financials followed by energy. But at any one point in time in 16, financials were way up on the top. But over time, they don't. And so far, when we looked into 17 and 18, we're finding some of the same patterns. So this is why you diversify into many different ones so that your portfolio can have an easy return. And that takes us to the end of the first part of financial markets, risk, reward, asset class, equities. And what we're going to do now is I'm going to give you a chance to think about all of this. And then we're going to look at the continuing part of this video.